Welcome to the coffee shop, everybody. This is your host and barista. We just did a video called Finding Liquidity and how to find it in the market. Now, in today's video, that's going to be the lessons plan that I did with a group called Trade with Confidence. Today, I'm going to show you what happens when price reaches back to your liquidity levels and how you're supposed to trade that. Because it's not enough to know where liquidity is in the market. You need to know how to trade that. I'm going from the low. I'm just looking to the left. That's it, right? I hit a candle. Now I'm going down here. So this primarily is my liquidity zone, okay? In this regard, I actually have a little gap taking place in here. I'm going to use the gap. Okay, I'm using the value of the gap. That should be the rest of the liquidity. Now the question is, how do I know there's liquidity here? Okay, that's very simple. Well, for me, right? It's very simple. What happens here is we have the market is originally in an uptrend, right? It's already in an uptrend. Let's just do this. It's moving up. I should constantly have breaks of structure to the long side. I should always have that, right? So if this is my swing high, okay, and this was my swing low, from my swing low, I should break the swing high. But in this regard, I end up with a new high. The only way I know that is because price moves up and then starts moving back down, okay? Immediately when it starts doing this, you can just look below you and say, why didn't I break this swing high? Well, that's because the amount of support used here, right? Remember, the wick has the support, majority of it. The amount of support being used here, the bullish orders being used here, were not able to continue breaking the structure that was already created earlier. So if you get a pullback away from structure, right? If you start pulling away from that structure and start making lower lows, look below you and find out where did the move up start? Where did it begin? Find the support and then look for the support prior to that. That's what you're doing. The wick is the support. If you look over here, let's just pretend there's a wick here, right? I know there isn't. I'm going to say, let's pretend there's a wick here. In this regard, there is no wick, so we'd use the close of the candle. I personally always use the close of the candle. Okay? So you go from the wick, where the most support is for this. There isn't enough orders taking place to break this, right? So you look down. You just look left and then down to the close. You draw out your liquidity. Liquidity means there were supporting orders here because you're in an uptrend. There are bullish orders here that were not enough to continue moving the market. So that means they're holding back. Now, why would they be holding back? Well, very simple. The bulls buy low and they continue and they sell high. This level means this price level was interesting enough for the bulls to stop buying so frequently. Stop putting in large orders. Now they're putting in less orders. So the price will stop moving and it will stop breaking structure. Like I said before, if your original trend is to the upside and the market starts moving against you, you want to put in orders so that you can break what's happening against you, right? You want to break that. So you must be a bull trying to break what the bears are trying to do. If you intentionally do not put in enough orders, then you must be happy with this price, or you must be happy with this price. You're okay with that. So they got everything that they needed to get. Anything after this, above this, would be momentum, right? So if I look at this, whatever, they stopped here, then you've got this taking place. And like I said earlier, somewhere in this place, you have a divergence. Why? Because the bulls don't care about this price anymore. They stop putting in orders and they're allowing the market to start falling. They want to get their clients in low and get them out high. If the clients are happy with that high price, then they stop buying orders. That's it, right? That's the sentimental way of looking at it. Let me see here. All right. So Bucky, does that describe a little bit better on how to draw them? All right, just let me know if that's enough, because I wanted to make sure that you understand how to draw them and what you do with them. Okay. So we get this move that did not break the swing high. Again, you wouldn't know about this move until it starts drawing against you, so you can look backwards. Now, this applies to every single time frame. I'm looking at a 10-second chart just to give you guys a heads up. I'm looking at a 10-second chart. So, and this is gold. So you have to imagine people are trading on all time frames. Don't think that it's only on what do you call it? That it's only on 1 hour, 4 hour, stuff like that. You don't have to assume that it's only there. It's on every single time frame. Thanks, Bucky. Any other questions? Just feel free. If there's any other confusing part, just let me know. Now the question is what do you do with liquidity once you've mapped it out? Okay. Now, it may seem like, oh, that's too quick, coffee shop crypto. How do I, this move is taking place. You're on a 10-second chart or I'm on a 1-minute chart. This move is going to come down and it's going to tap into my liquidity very quickly. Yes, you are absolutely right. You're absolutely right. But again, I'm looking at a very short time frame. Okay. You can literally zoom out. Okay. You can zoom out. I don't want to see that part of the chart. And you can find the places that a swing high was made that did not break a previous, right? It did not break a previous structure, okay? We have structure here, okay? And you see you've got a swing high here with, it has to have a swing low on both sides. You have to have that, right? So you've got a low here. There's the high. The closing value of this candle did not exceed the structure. You have to close above that structure, right? And then you have to have a low, right? I said you have to have this shape. Right? You got to have a low and a higher low. You have to have that. So you actually have liquidity formed here. Okay. It's on a lower time frame. So if this is a 10-second chart move, right? If this is a 10-second chart move, if I look down at, let's say, a 5-second or a 3-second, then I would see this a lot easier. This is liquidity. So what are you looking for? You're looking for the low of this candle, right? Here's the low of this candle. I'm just going to go this way until I get a closing value right here. And again, another gap. So we're here, right? Let's plot this out. And I know I didn't answer the question yet. What do you do with liquidity once you've mapped it out? I'm going to show you in a second. Now, I just picked this one. I know there's other liquidity. I'm just picking this one for now, okay? So you see the market starts pulling against you. And this is the reason why you're supposed to map out liquidity way, like look far back and find liquidity. We're here on the time frame of the chart. Let's say you came up and you start charting and analyzing. You're trading. You traded all of this, but you see, better yet, let's say you started trading at this time of the day, which is really great because you got some nice long moves coming up, right? Great. You made your bank. Great. Where do you want to get out? Okay. You know that you can start targeting if the market reverses. You can start targeting these levels when the market starts falling. That's the purpose of liquidity. You use them as take profit levels because you have to assume that when the market gets down to this level, it's going to wipe out the liquidity and price will stop moving. When there's no liquidity, price can't move. It has to create new liquidity, right? So let's see where price is now. Right here, you see this little move takes place and it continues on probably because there's more liquidity down here. Yeah, there's liquidity at this level. This close is not higher than this high. So that means the previous low, the low that made this move up, right? Just taking this, go down to the close here. There's a nice one there. This is a valid swing low. And there's more liquidity below this one, right? I'm just following liquidity down, right? Here's the low. Here's this one. And there's liquidity here, okay? And there's probably a bunch of it. There's another one here. Nope, not there. Here, there's another one here. Once you get good at spotting liquidity, right, you can find just all of them, okay? And when the market wipes out liquidity, see, comes down, hits this level, has trouble, and it either has to create new liquidity or seek other liquidity. Keeps doing it over and over again, right? So liquidity is a really handy tool to use as your take profits. So for me, liquidity works better than support and resistance because support and resistance is an active area of high volume. I want to find the place where the orders were left open because for sure price is going to go is going to get there, and I'll be done for the day. Because the closer any price gets to liquidity, the faster it moves. And then it gets down to a consolidation. That was lesson number 2 regarding liquidity and what to do once you reach liquidity. Lesson 3 is coming up next. Hope you enjoyed this one, and keep tuned in for the following ones.